Hello, everyone. Today, we're going to do something different. We're going to study how Warren Buffett invests and learn from the master himself. So let's dive into Warren Buffett's 9-step process. Step 1. Business understanding. Before investing, Buffett immerses himself deeply in the business. He wants to know what the business sells, who buys it, and how the business makes money. He asks questions about competition, customers, suppliers, and future prospects. Buffett only invests in businesses he understands, so don't be afraid to say, "I don't know," if you don't understand something. Take your time to research and learn. This is the foundation of Step 1, understanding the business. In addition to understanding the business, it's also important to understand the economic moat, which is the advantage that protects a company from competition. It can be a strong brand, low cost, a wide network, or high switching costs. But remember, moats aren't permanent. They need constant maintenance. And the real challenge is predicting whether the moat will survive the next 10 years. Step 2. Industry Cycle Deep Dive. To invest like Buffett, you must know the industry cycle. Is the industry growing, maturing, or declining? Studying history helps you spot patterns and prepare for downturns. Think about these questions. How deep are the cyclical downturns? What are the key drivers of supply and demand? Are there barriers to entry? How do interest rates and inflation affect the sector? It's crucial to model both the best case and the worst case scenario. The best case scenario, usually based on optimistic assumptions, and the worst case scenario, which considers pessimistic assumptions. By analyzing both scenarios, you gain a more balanced perspective and better assess the company's future. Step 3. Management quality and capital allocation. Strong companies need smart leaders. Review their track record. Do they reinvest profits or pay dividends? Have they taken on too much debt or bought back shares? Shareholder-aligned management is crucial because it aligns the interest of the management with those of the shareholders. Remember, managers who make decisions that benefit themselves at the expense of shareholders can harm the company's long-term performance. So look out for red flags like overly high compensation packages for executives or a lack of clarity regarding the succession plan. Step 4. Financial strength. Analyze 10-year trends in revenue, earnings, cash flow, and debt. Look for stability and resilience. Run a stress test using ratios like interest coverage and current ratio to see how well the company can handle financial pressure. Early warning signs of financial distress include declining revenues, shrinking profit margins, and increasing debt levels. Be wary of companies that report losses in multiple periods, as it may indicate fundamental problems in the business model. Step 5. Intrinsic value estimation. Now we'll estimate intrinsic value, the true worth of the business. Build a conservative DCF model using base, bullish, and bearish forecasts. Choose a discount rate that reflects the business risk. Higher risk means a higher discount rate. Base case should reflect realistic expectations and consider a 2 to 3% terminal growth rate. Compare your intrinsic value to the market price and decide if it's undervalued. You can also use historical and peer group multiples such as PE and PFCF to cross-check your valuation. Remember, these multiples provide a quick assessment but shouldn't be the sole basis for your valuation. Step 6. Risk assessment. Identify potential threats to earnings. Are there operational risks, regulatory changes, technological disruptions, or risks related to broader economic shocks? Estimate the impact of each risk. Quantifying the impact of risks helps you prioritize them and understand their potential effect on the company's financial performance. Also, flag any complexity or opacity. Sometimes a business might be intricate or hard to understand. If you can't grasp the full picture, it's a sign to move on. There are plenty of other investment opportunities out there. Step 7. Catalysts and long-term outlook. Now find short-term catalysts that could move the stock price. These could be events that may not be fully priced in by the market. Also, explore long-term forces shaping the business. Consider any environmental, social, and governance issues that might impact the company's future. Think about future regulatory changes or shifts in social responsibility. Staying informed about these issues helps you anticipate challenges and spot potential opportunities. Step 8. Margin of safety and investment decision. Here's the final step. Compare the market price to your intrinsic value estimate. Determine your margin of safety, typically 10 to 20%. Make a clear decision: buy, watch, or pass, backed by the facts you've gathered throughout the process. If the stock is undervalued and within your margin of safety, consider buying it. If it's close to intrinsic value, keep it on your watch list for potential buying opportunities in the future. And if the stock is overvalued or presents significant risks, pass on it. Investing involves making tough choices, but with careful analysis, you can make better decisions. Step 9. Actionable summary. Summarize your key findings. Note 3 top reasons to invest, 3 major risks, and your checklist score. The checklist includes moat, management, financials, valuation, and risk, each worth 20 points. Add up the scores to get your total. Aim for a score of 80 or above, but if a company scores high in some areas and low in others, further investigation may be needed. For example, a company with a great product and management but poor financials might still be worth considering if the other factors are strong. So there you have it, folks, a masterclass in investing straight from the Oracle of Omaha himself. Let's apply this framework to a real company and watch how it works in action. In this example, we'll walk through the step-by-step process, showing you how to analyze a company and evaluate its investment potential. We hope you enjoyed this journey through Warren Buffett's legendary investment approach. If you want to master this powerful framework and level up your investment game, this course is designed to deepen your understanding of Warren Buffett's investment approach and equip you with the skills to analyze companies like a seasoned investor. Plus, it's filled with practical examples, case studies, and actionable takeaways. Don't miss out on this opportunity to learn from one of the greatest investors of our time. Click the link below to enroll today and start your path towards smarter, more informed investment decisions. Now, here's a quick quiz to test your knowledge. Which step involves assessing the strength and quality of a company's management team? Pause the video and comment your answer below. If you answered Step 3, you're absolutely right. Management quality is a crucial part of Buffett's 9-step process. It's essential to evaluate their track record, decision-making abilities, and alignment with shareholder interests. So keep an eye on those management moves. They can make or break a company's performance. Investing isn't just about picking winning stocks. It's about making smart, informed decisions. Thanks for watching. Subscribe to the channel for more insightful investment lessons. Keep honing your skills and stay sharp in your financial journey. Until next time, happy investing.